Joining me now is Dan Chung, Alger CEO and CIO. He's also a portfolio manager for the Alger Capital Appreciation Fund, which is ranked #1 on the 2024 Wall Street Journal Winner's Circle list. Dan, good to see you.
Thank you, Mike.
So this move in semis, obviously headline driven, but it comes in context of, we're just seeing a little bit of an unwind of this trade in mega cap growth stocks that's been hitting the NASDAQ for a while. Has anything changed in your view in terms of what might drive growth in these areas and what's worth playing now?
I don't think anything's really changed. It's the same drivers: cloud computing, investments in artificial intelligence, digital business and marketing, genomics and healthcare. So all of these trends are long-term trends still in place.
And in terms of this particular kind of semi-equipment export, I mean, we've been dealing with this for a while, right? I mean, there's like specific product numbers that can or can't be exported. Certain machines can or can't be serviced. One generation of chip is okay and one's not. It seems like that hasn't necessarily impacted a lot of the companies necessarily. So is there a reason to think that the uncertainty around this can last for a while?
So, I mean, these are politically sensitive companies for good reason, because they are the most vital part of the semiconductor industry. ASML in particular is unique.
Sure.
They have already given up quite a bit of revenues because of the restrictions in exports to China. And I think the political football will continue around this. But I think we should all understand we still have more trade than we don't have trade with China. We still have more trade with many of our partners around the world, even as we argue about the political ramifications. So I think these companies are going to end up doing incredibly well one way or the other over the multiple years. And this noise is creating a buying opportunity, or will potentially create one pretty soon.
You mentioned the AI, of course, being one of the principal themes. And what we know for sure is this massive urgent investment cycle. We see the CapEx numbers by all the companies. You see the revenue from NVIDIA and elsewhere. But there's this undercurrent of what's next? Where's the payoff? Where's the killer app? Are we sure that the companies investing in all this are going to get paid back on it? Is that filtering into your thinking at all?
Absolutely. I mean, we're bottoms-up fundamental stock pickers, and they're going to be winners and losers. It's too early to say, really, for most companies, whether they're going to be a winner or losers.
Yeah.
There are some companies, of course, that are leading, companies like Microsoft and NVIDIA. I think their positions are unassailable. I think Amazon, as a user of AI to improve its efficiency, is kind of unassailable as well. But there's a lot of others where it's a little less clear. Software, in particular, has a lot of companies where they could be winners and they could actually be losers.
Yeah, you've seen some I guess some uncertainty around some of those franchises, right, in software, business software, where it's, you wonder if they're going to be disintermediated. Are there others that you feel as if got it figured out in software, aside from Microsoft?
Well, got it figured out. I think one area is cybersecurity.
Yeah.
This is absolutely an area of critical importance. So companies like CrowdStrike in particular, securing cloud computing, applications running on the cloud. There's no doubt that, unfortunately, AI will be applied, both for and against us, on both sides of that battle. So that's going to be an intense battle. We've already seen major hacks this year and data breaches. And so investment there will certainly continue. The companies that are leading today are likely to benefit from AI as they use it, but also because of the urgency with which businesses and governments need to implement it.
One of the reasons it seemed that you did get such concentrated outperformance by a lot of those, big NASDAQ names all year was this sort of scarcity of conviction that you have multi-year earnings growth ahead of them, right? I mean, there's a handful of companies where you can be really sure, and then the rest of the market, not as much. Outside of tech, where have you been finding that? I mean, because you obviously don't only own tech.
Right. Actually, we had a great year, obviously. But only 40% of our outperformance came from tech. 60% came from pretty much equally healthcare, consumer discretionary, and actually industrials. And it's really a stock picker's market. So in healthcare, for example, companies that are using genomics and computing to improve cancer detection. So Natera has been one of our favorites for multiple years. Surprisingly, in the industrial sector, there's a renaissance in both things like renewables, but also, for example, railroads. Railroads are getting a lot of investment after a long down cycle of investment. So a company like Westinghouse Air Brake did very well last year. And then finally, the consumer. A lot of noise about the consumer, but one thing we know about the American consumer is they love new things. They're constantly looking for good deals. So things like online gambling and DraftKings did exceptionally well. Amazon, of course, did quite well. But also the maker of Hoka running shoes, and Uggs, Deckers.
Deckers, yeah.
So, it's pick your spots, look for the growth, and this market I think has plenty of room to run.
So you're a believer in the DraftKings, they're going to get big enough in scale to really be very profitable?
Well, they have pretty successfully become a 1 and 2 in most markets. And meanwhile, if you think about online betting and sports betting in particular, this is a great add-on to the entertainment of watching sports. Which we all love pretty much in one form or another.
That's right, yeah.
I look at it as
the leagues need it, the networks need it, everybody needs it.
Right.